clients to the liquidity factor. So you had a house, you couldn't sell it. Your business was shut. Some people didn't have money, there's no salary. You needed money. And they realized that liquidity is a cost. And India, people used to buy 2 houses, 3 houses, multiple things. So suddenly real estate, they realized it's not easy to unlock it as what was thought earlier because it was a buyer's market. So that changed the perception. Second, very important, technology. I think all these apps which are there in the market, the ease of which the integration has happened across onboarding to transaction, you can literally do it within 5 minutes. I think that's been a big change of behavior. So I think if you combine the two of factoring illiquidity, second, factoring the fact that you can actually make money because now historical data was there to show for 20 years that mutual funds have done well. Third, the mutual fund distributors have played a large part in terms of working towards a goal-based planning. And a lot of investors now work towards goal-based planning. So 10 years back, if these kind of markets were there, choppy, I can guarantee you the sell button would have been hit very often. But now they don't hit the sell button, they do consult. So I think these are the slight changes that have happened in the investor behavior. And you're right, it's really from 2021 onwards that you're seeing this very robust investor behavior that we have.
Had it not been for technology, you think this democratization of financial savings that one has seen at scale and at mass, that wouldn't have happened?
Yes, of course it is. But the reason why so many people shifted was the fact that they realized that when you need money, you need to factor in that liquidity. And today, and we have lots of anecdotal examples, where clients said, I needed money and actually I could redeem my mutual fund unit. I couldn't even go to the bank to redeem my FD because my bank was 10 kilometers away and I had to take my FD certificate to the bank and it was not allowed, right? So I think those were the baby steps which kind of fueled the whole tech and the whole idea of why mutual funds should be looked at in a more positive light. Till then, it was more a short-term, thode paise bana lo kind of a game. But serious money started to coming in after that. And if you look at our SIP numbers, it's a testimony to that. Till 2020, what was the size of our SIP? And look at it after that. Yeah. It's just kind of hit a J curve.
Having said that, given this market volatility that one has currently seen in the challenging times, do you ever wonder that the SIP investor, which has not seen a bear market, has been patient, yes, but it's only small ticket money that we've seen trickle in. So, since 2020, they've pretty much seen a one-way move up in the market. Do you worry that at some point they could redeem?
The answer to this is actually yes and no. So let me say why yes first, okay? It's the younger investor who is more adept at using the fintech apps to transact. And it's literally they order a Uber to go to a party and while the Uber is coming, what do? They open their app and buy a mutual fund or sell a mutual fund. Or they say, oh, this new gizmo has come in the market, I need to buy it, they buy and sell it. I think it is those people who get shocked quickly when this volatility happens. So we haven't seen a bear market, but have we seen a scary market in the last 12 months? The answer is yes. A lot more calls have come to us. A lot more people are asking us questions. But that's what I'm saying. Earlier, people would just send the redemption to the office. Now they are asking questions. What should we do? And we can now, the beauty about tech is that you got data to show to every investor that, this happened in 2008, this happened in 2000, this happened in later on. And every time this has happened in COVID, the markets fell 30% plus within like 15 days. So you lost a lot of money. But when the recovery happens, all those units that you have accumulated at the lower end actually tend to go up. So I think data plays very important part. And today with the infographics being made like this, little drop of hat, anybody can put in a few lines and the artificial intelligence just gives you a beautiful infographic. I think no, I answered the yes. Let me tell you why I'm not so worried about it. Is because the investors are asking questions. I mean, we do have distributors in this room, and you can ask them. They aren't seeing too much redemption. Yes, the redemptions are there, but it's not peaked, despite 15 months not being very good. So they are patient, and we hope that gets rewarded in a short time to come.
Hope so. Since you are talking about data points, I do have one, and this is SEBI Investor Survey 2025, though, which is actually revealing a very striking gap. It says that 63% of households are aware of securities market products, but only 9.5% out of that 63% actively invest. Why do you think such a large gap?
So this is a 2025 survey, right, of SEBI. So 2025 is when the market's starting going extremely topsy-turvy.
Yeah.
So when a new investor wants to come into the market, he hesitates because he would have seen a 1.5% correction just the previous day. So he just wants to play it careful. So that's one reason. The second reason actually is a little funny, according to me. The new investors, and by the way, in 24-25, we added about 8 lakh new investors in the industry, first-time industry investors. So it's not a small number at all. And hopefully if the markets recover quickly, like some of the other panelists were saying in a short time, you will see this number going to 1.5 crore for a year very easily. Okay, so the gap also is because I think as an industry where we have not done well, okay, is we are too technical in our conversations. Okay, we talk of ratios, we talk of short forms, we talk of terms used globally. The retail investor does not understand that. Okay? Again, we are a very English and to some extent Hindi. We are not Marathi, we are not Bengali, we are not Tamil, we are not Kannada, we are not Assamese, we are not Gorkha. We are not that in terms of communication. So, you wear a tie and a suit and you go to a Udupi joint. You do get some stares, right? Who's this person who's come to this Udupi joint? Well, it's like that. So if you're going to talk too technical, sometimes people believe that this product may not be for us. I don't understand this 3-year forward, 2-year, rolling returns, etc., etc. They want a simple thing. Is this giving me better than my FD returns? What kind of safety is there? And they want it in the local language. I think that's something we as an industry have not done very well. And that's one of the reasons this big gap exists.
Also, I wanted to talk about, urban participation stands at about 15%, while rural is just 6%. And we've had conversations earlier on ET Now, and we've talked about tier 2, tier 3 cities, beyond metros. When is it that you see active participation increase from those geographies?
So if you take the same number and do it on number of transactions, you'll have a very different statistics. Okay. Today, the number of SIPs which are coming in from the beyond 30 cities is outpacing the SIPs coming from the top 30 cities. Okay. The reason why we see this data is we are very AUM centric. I think as an industry, and I've said this 10, 12 years back, I requested the regulator, please stop ranking us on AUM and rank us on number of investors added to the industry. That's what is mutual fund all about. And you will actually see this change if you do it on a transaction basis, number of investors who have been added. And I just saw Karan sitting here. And if you ask Karan, he'll vouch this fact that 10 years back, all his clients were from the top 12 cities. Today you ask him, He'll say, city number 30 to city number 100, I've got X number of clients.
It's difficult to get appointment with Karan in Mumbai. Keep it at that.
But he will agree to this fact. And that's the change which is happening in India. And obviously the people in Mumbai, Delhi, Bangalore are richer. So they put a bigger amount of money. The smaller city guys are transacting. So please do a program. I would say ET now should take the lead of doing it, that how the smaller cities are outpacing the growth in terms of number of transactions and number of investors.
Absolutely, we will. And we will take you along with us to all the B30 cities. But I want to talk about, the SIPS flows. So far, they've been very, very consistent. You made a very interesting point that, people are not in a hurry to sell now. It's no more like an Amazon return. They want reasoning, they want questioning, they want to understand what's happening in the world right now. When you get panic calls from investors, what do you tell them about the state of the markets right now?
So like I said, are we communicating to the investor and showing him data? Because data is the truth, right? You can't fudge data. You're just showing him that yes, there are times when your SIP may not give returns for 15 months, 18 months. At times you'll have SIP returns which are negative. But one up cycle, all those negative SIPs suddenly become a plus 14 or plus 18% kind of a return because you've accumulated them at a lower NAV. I think we need to continue to talk to them and show this data on a more frequent basis because memory is short. And the other thing is that the younger investors, especially those who are under 30, they don't have the amount of patience to listen to us for half an hour. So you need to, unfortunately or fortunately,
do a reel.
Crunch.
Then you'll get their attention.
Do a reel or crunch your conversation to under a minute and show them A, B, C, and they say, okay, I understand. Can you email it to me? And then they're willing to look at it.
Since you're talking about the younger investors, this growing conversation around over-financialization also at some level. Because the younger generation, the mindset is about instant gratification. They are the trade-in, trade-out mentality right now. That's the mindset that they come from. Do you think that also is a little risky at this juncture too? And we've seen the regulators take F&O trading and the curbs there so seriously.
Oh, it's extremely risky, and we've seen this in the digital currencies that people play around with, right? And now it's not so famous to do it because people have lost money in the last 1 year or so. So a lot of youngsters who were making money as the markets grew, or the digital currencies gave obscene returns, I would say, have actually lost 30, 40, 50% of their money in the current market. So that makes a big difference. So markets teach them a lesson that it's not easy to make money in this market. I think Vijay said that patience is, not too many people like bungee jumping, right? Especially if you're above 40. There are some people who do it, but if you're 30 and below, virtually everybody wants to go into a bungee, right? Now, why is that? Because the thrill and excitement. So I keep telling the younger set of people that, you know what, you should take out your money and keep a thrill and excitement kitty. And use that for thrill and excitement. Don't worry about it. Go to these exotic islands, party a lot, but also keep some money safe and the boring money, which will be there. You'll not look at it for 5 years, 10 years. But that's how life is. And I think if we do not listen to investor behavior, if you don't listen to how investor perceptions are changing, and just imagine I go to a young kid and tell him or her that, listen, you don't party for the next 10 years. When you're 40 years old, you'll be a very rich person. He'll throw me out of the window.
But definitely will.
Correct? So you need to have that entertainment kitty, excitement kitty, and enjoy life. So I don't see that to be, but that should be built as a part of your planning process, is where I'm coming from.
So given the demographic dividend, given that the average age in India is 28 years old now, in the next 10 years, where do you think household contribution to financial savings would stand at, and specifically to mutual funds?
Well, we were like low single digits in 21. We have now reached low double digits. So in 4 years, it's gone exponentially up. Can we see a 30%, 40% in the next 10 years? Why not? Because the engagement levels are improving between distribution partners and clients. Tech is enabling more people to come into our industry. Awareness is growing. I think Amphi is doing a phenomenal job in terms of sending the right messages. We started with mutual fund sahi hai, and now we are talking about patience because of volatility in the market, and you all have seen all those ads.
Yeah.
So I think the industry, I've never seen an industry so good, by the way. We have a unified KRA. We have a unified...
And what really needs to be done to take the industry to the next level. Thank you so much for your time
I'm a
today.
super bull like Rhythm was when he talked of equity markets. I think our industry, we will do exceedingly well. Thank you so much for having me.
Thank you so much for your time.